Good morning. I am Bob Cusack, Editor-in-Chief of The Hill. We are live streaming on thehill.com. I first want to thank Property Casualty Insurers Association of America for sponsoring this event, and feel free to join the conversation on Twitter, as you'll see up there, using the hashtag InsuranceRegsForum. We've got a great panel discussion, a couple of members and experts on insurance regulation. Kevin Cirilli is going to be our moderator for the day. He covers finance for us.
So we have Mark Calabria. He is the Director of Finance Regulation Studies at the Cato Institute. And we also have Adam Posen. He is the President of the Peterson Institute for International Economics. We have Christina Urias, and she is the Managing Director of International Insurance Regulatory Affairs at the National Association of Insurance Commissioners. And Terry Vaughn, the Dean of the College of Business and Public Administration at Drake University, an all-star panel this morning. So thank you guys for talking to The Hill. And, you know, I guess we'll start it off with you, Mark, in terms of what did you make of the conversation that we just saw with the lawmakers? What stood out, and where do you think the congressional role is going as we move forward with this debate?
Sure. Well, first let me say I was impressed with how informed and I thought thoughtful the conversation was. Better than the usual average congressional discussion. But I felt that, to me, one of the appropriate and important roles is congressional oversight. So just having the views of the members of Congress reflecting their constituents and the regulators hearing their views is very important, and I don't think we recognize that sometimes. Sometimes that's even more important than legislating. So I think that, to me, I feel a little more confidence that some of the members on both sides of the Financial Services Committee are going to have a little more informed dialogue and oversight, and that the regulators are going to hear this. And so hopefully that is something that is incorporated in the views at Treasury and the Fed, and then the truths that they take with them, and that, again, you start to see that balance. So I do believe that if you can give a thoughtful congressional response to regulators, that you see some movement.
And then,
Do we pass it down?
What about in terms of the international, what role do you specifically see in terms of how the international regulators are influencing the folks here in the U.S.? Would you agree with the congressman as to see what we're seeing, or what would you make of that?
Yes, I do agree with the congressman to the extent that the FSB, we have U.S. representatives there, the U.S. Treasury and the SEC, but the state regulators are not participants. They have asked to become participants, but to no avail. And I think when you have the insurance expertise that exists in the 50 states and the territories for years and years, and as the congressman stated, successfully regulating the industry, I think it's important to have that input on the international stage. The FSB has a great deal of influence over what's happening at the IAIS, and where these insurance core principles and the international capital standard are being developed. I think it's very important that the state regulators have a voice at that table. Now, that's not to say we don't participate at the IAIS, because we do, but that voice needs to be loud and clear, because the success of the state regulator system is one in the U.S., and we don't want to do anything that would jeopardize that.
I just have to weigh in here, because I think it's important to understand how the FSB is structured and how it works. And the members of the FSB, in fact, none of Team USA is sitting at the FSB. The Federal Reserve and the Treasury are, but no one from Team USA. The insurance expertise at the FSB is virtually non-existent. You have a couple of people who are the Secretariat of the IIS, the chairperson of the IIS, and beyond that, you have people mostly who have come to the FSB from integrated supervisors that cover banking, insurance, and securities. They have backgrounds in banking. They're very, very talented people. They're working very hard to try to do what's right, but they don't know insurance. And it is only natural, when you spend that much time in a field, that you come to a problem and you look at it through a particular prism. I'm going to tell a story, if I can. You go. Okay.
No, it's not. The fight's over. So unfortunately, Terry and the congressman completely missed the point. basically, because they want to win this bill, they're all talking about it as though it's a process issue and using apple pie terms like transparency. That's not the problem. Everybody knows what's going on in the room. Everybody knows what the issue is. The issue is the Europeans are trying to export Solvency II, which is a bad regulation, and which would specifically raise too much capital on U.S. and other non-European firms. And the European insurers know it's a bad regulation, but they don't feel they can stop it, so they're trying to make sure it gets imposed on as many other people as possible. And so they don't lose their competitive advantage. Thus, the issue isn't so much about process. Putting in a veto against an international agreement isn't the issue. The issue is to win against this really bad idea, and not just because it might mark up consumer prices, again, an apple pie issue. That's fine, but it might be worth it if there was a systemic risk. The issue is you're not getting the systemic risk from the life insurers. The capital standard doesn't address whatever systemic risk you got from the life insurers. And so the final process point, before I give it back to Terry's much more entertaining story, is that this is what goes with the virtues of having the 54 commissioners at the state level, is the absence of a coherent federal expertise and representative. And that is showing up now, not just at the FSB, but at the IAIS. We should be able to kill this on its merits, and this is the one way in which the 54 is a problem for us. The 54 has to get there, because you all should be able to help kill this at the IAIS, while us central bank types are trying to kill it at the FSB.
Okay, I'm going to tell but I'm still going to tell my story. Okay, so I was at a meeting. This goes back, a year, maybe a year and a half ago. And I was in a meeting in another country where the regulator from the integrated supervisor, the head of the integrated supervisor, got up and gave a speech to a group of insurance people that was wonderful. It was all about how insurance is different from banking, and we are not going to regulate the insurance companies like banks. We get that they are different. They have a different liability structure and so forth. Then he quit speaking, and he said, are there any questions? And the first question out was about a new regulation that they were going to impose on the insurance sector. And this man, who had just finished this wonderful speech, said, well, the banks have to do it. And so we don't understand why you shouldn't have to. And so the problem we have is that the world is being run by folks with the banking, and the insurance industry is operating in a prove to us that it shouldn't apply to you world. So all the banking stuff you're having to fight against. At the same time, the insurance regulators are saying then, well, we've got insurance issues we have to deal with too. So now you're getting all this stuff piled on top of each other.
Well, I think it's an interesting point. And in terms of harmonization, I think pretty much I was interested I think folks would agree that if you do have harmonization, it could potentially reduce costs if you have the right mix of folks at the state level influencing the federal level. So I guess a two-pronged question would be, does harmonization, if it's the right harmonization, lower consumer costs for Americans? And then also, how do you encourage harmonization? We're talking a lot about the problem, but is there any solution to it that you would propose?
Well, I guess I'm going to start with the economist in me and say, on one hand and on the other hand, there are costs and benefits there. So there certainly can get you some economies of scale and standardization from harmonization. I think that that's true. My own feeling is I think that that's often exaggerated, the benefits, but I think that the benefits are real, even if they're not as large as I think as they're sometimes claimed. On the other hand, I worry about moving away from a diverse system. So it's not simply that you want diversities across industries. I mean, for instance, to me, a robust financial system would be when one sector like banks wants to sell, there might be another sector like insurance companies who want to buy. And so to me, you have to have that diversity within the system. I also think it's important to have diversities across countries. I'm a little less sympathetic to the concerns about, why everybody needs to start to have the same regulatory system. Because again, I would like it, when the U.S. wants to sell, it would be nice if Europe wants to buy. So again, to me, having those two sides of those transactions, and I do worry about the push to harmonization just ends up with far more homogeneity across balance sheets of various entities. And I think that creates systemic risk in itself. I will say part of my concern, maybe I'm going to make a little pitch for the process issue that I think is relevant. I don't worry about U.S. regulators somehow getting hoodwinked by European regulators. I think our regulators are fairly aggressive. I think, if anything, I mean, we're about the only country in the world that can force the international banking system to be an arm of our foreign policy. Nobody else gets away with that. So we win. We win most of the time on those things. The concern to me about process-wise is, the sort of phrase "Team USA" was used. There's a variety of inputs there, and so I worry that the Treasury Fed perspective sometimes is consistent with good policy, sometimes is consistent with insurance, sometimes isn't. And so the point about how does that insurance view get held, and I'll end with saying, I do worry as well, because to me one of the lessons of the Basel process is that when you get a bunch of finance ministers at the table, they all start to think about, how do I create captive markets for my debt that I have to sell? And so that's less of a problem in the U.S., but it wasn't a mistake. It wasn't by accident that French and German banks all ended up with lots of Greek debt. That was a direct outcome of the process we had by having finance ministers at the table driving that. I don't know what the solution to that is, but I think we do need to be cognizant of the fiscal motives that are sometimes involved in financial regulation.
Yeah, just a quick comment. I really do underscore what you said, Mark, in terms of diversity. Harmonization has value to a point, and I think it yields cooperation and collaboration. I've found in my experience sometimes semantics, meaning of words, convergence. To one person that might mean one thing, reaching a mutual point of understanding. To another person it might mean do it our way. So you have to have a respect for the language, a respect for the culture, the technical differences, the operational differences in each regulatory system. I think it's important that we have these dialogues. Our insurance is global now, and we need to have that greater understanding, but there's power in diversity. And there's strength in the U.S. system that remains diverse. We are cohesive through the NAIC, a cohesive regulatory system that we will take the best is what is out there to offer on the international stage to bring it into our system.
I think we have to look at this. I basically agree with Mark as well, but I think we have to look at this slightly differently. Team USA, with all due respect to my friends in the insurance industry in this room, is about the public welfare. It's not about the welfare of American companies vis-a-vis other companies. I know you say that. No, it should be. And you can get from that principle to still opposing this regulation, is my point. That the issue which Terry raised about everybody trying to cram down a bank-type regulation, which means accumulating lots of short-term capital in the form of government bonds, as Mark said, is the problem. And the reason that harmonization of that sort makes sense for banks and not for insurance is twofold. First, banks are subject to liquidity to runs in a way that insurers are not, and that the state-level insurers make sure they cannot be. Second, there is a possibility of what we call regulatory arbitrage, meaning if you don't like how your regulator's treating you, you go do your dodgy stuff in a district where they're less restricted. That's much less possible. It's not impossible, but it's much less possible in insurance than it is in banking. So therefore, the impetus to have to harmonize, or rather the cost of diversity, is much lower in insurance than it is in banking. So I think we're all ending up in the same place. I just want to make the case that this isn't about necessarily disadvantaging U.S. business. It's about financial stability.
I agree with you completely, and if my comments came across any other way, I want to correct that, because for me this has always been about financial stability, and this has been about the fact that during the crisis the insurance sector did act as a source of stability, and we don't want to screw that up. The next time we want them to be around here to act as and this is one of the frustrations that I have, is that there are, and you pointed to it, that the insurance sector has the way it operates and the way that regulatory arbitrage plays out is very different than in banking. And we don't see that. I haven't seen that analysis and thought given to the issue of regulatory arbitrage. What is the problem of regulatory arbitrage? How can it be dealt with? Instead, what we see is a jump from there's a possibility of regulatory arbitrage, therefore we need a global capital standard, which is, I think, because people with a banking mindset, they can't walk through the other steps because they've already done it for banking.
I think it's an interesting point, and I was just getting told to talk. Usually I'm loud enough, but I'm pretty loud. Mark, I'm a pretty loud guy. In terms of, I think this issue is part of a larger debate in terms of how the banking regulations and insurance regulations across the board for Dodd-Frank have been, perhaps a one-size-fits-all, as we've heard frequently today. But I want to talk about transparency, because I think that in terms of influence, I'm curious for your thoughts, and as a journalist, transparency is always a fun issue to talk about. In terms of how transparent you think organizations like FSOC, you think organizations like the Federal Reserve and U.S. regulators, have they been transparent enough in their communications with the international regulators, as well as their coordination at the state level, to be fair to not only the industry, but more importantly, the consumers, and how that impacts them? And if they're not transparent enough, what can be done? Does Congress play a role, or what role can be done to increase transparency? And I will start with Christina.
Well, you touched on a very big issue that was just recently taken up at the IAIS, where the observers, the stakeholder companies, are no longer in the room when the committee meetings are taking place for the development of these ICS principles and the standards. The NAIC voted against that decision. Our federal colleagues did not. And so,
I just want to underscore that. So these decisions are being made behind closed doors?
well, they have stakeholder meetings. They do gather input, but there are closed meetings, yes. And the criticism is that we, the stakeholders, want to be in the room when those decisions and development is taking place, as it has been in the past. So I think, all for transparency. That is the cornerstone of NAIC processes. We have open meetings, we have open dialogues, we put out position statements. Everyone knows where the NAIC stands on policy and positions. That's not necessarily the case at a given point in time with our federal counterparts. So yes, increased transparency for sure.
Yeah, I just want to say I appreciate the need for supervisors to have conversations not in public. I appreciate that. And I also, so I'm not necessarily going to weigh in specifically on this point. I do want to say, however, the argument that I've heard that closing the meetings is to avoid the influence of industry on the decisions is a completely flawed argument. Because what happens, and I saw this when I was at the IIS, the European insurance companies know what's going on. The big global European insurance companies, they know what's going on. They've got relationships, they've got people who know the regulators well, there is a very close communication. What you do is cut out the smaller companies, the diverse part of the market, and you actually, from my perspective, increase the risk of the regulators being captured by the big companies because they're the only ones with the relationships. So I'm very, I dispute the argument that it will create less industry influence.
Just quickly, just more a compliment, that I agree with Mark's point. The U.S. regulators are very powerful in most international discussions, but in this particular area, what's happened is in part because of the structure of our regulators versus the kinds of very tight ties to a centralized Brussels that Terry's making reference to, and in part because our regulators, in a sense, admit that insurance is safer, so they're much more concerned about the bank regulation, the broker-dealer regulation, shadow banking regulation. It ends up being something that gets traded off with the Europeans. And then there's this false idea, which transparency or not, that, okay, we can keep it from happening here, but then it filters into this international capital standard, and other countries outside of Europe get pressure on them to behave towards the European model. And so again, I'm emphasizing the issue, less the process, because I'm not a Hill person. It's that's where the focus has to be. It has to be the U.S. not just saying, okay, as long as you don't put it internally to the U.S., we'll let it go. It has to shift to not having the ICIS impose this heavy international capital standard and telling the Thailands and the Brazils and the Mexicos and the pick whoever else, Israel, Morocco, that you don't have to go that route. That's going to be the issue.
Let's talk a little bit about sort of the process, and Mark, I'll start with you for this. In terms of congressional fixes, when you look at how we've seen the the community banking industry, apologies, the community banking industry trying to get a position on the Federal Reserve board for a specific type of view to be represented on the Fed board. Is that a way into this where you could have potentially Congress mandating that the insurance industry have a seat at the table in terms of who's represented for the international regulation? Is there something like that that can happen? Again, what is it more just the Congress needs to kickstart the conversation, or what? And with regards to Senator Shelby's bill, how is that playing out? What could we see with Congress?
So let me start out with your first question about, I don't believe there's any discussion about saying, earmarking a seat at the Fed for insurance. Certainly that is theoretically feasible. I'll note that Section 10 of the Federal Reserve Act, requires diversity for industry, ag, commerce, and all sorts of things, which normally gets ignored anyhow. I'll note, even as an economist, I don't remember any earmarking for academics on the board. But that said, that said, you certainly could go that route, and I think if you are in a world, if we're still having this conversation in 5 years, then I think proposals like that will surface. It's a broader issue, and I do think that some of the transparency demands from the Hill are coming, quite frankly, from a lack of trust. Now, whether it's also an issue of the very partisan way in which Dodd-Frank and FSOC were set up, whether it's a sense from Republicans on the Hill that they have been ignored or sidelined in the process. So to me, there's got to be a bilateral. And again, we've already seen some of this. Certainly the Fed, they're aware that they have a trust issue with the Hill, and they're working to fix that. Whether it will be sufficient, only time will tell. But I think it's fair to say they're aware of it. So, and so some of that process has to happen where members feel like there's a two-way dialogue and that their views are being represented. Again, I think in a perfect world, whatever we had done, financial reform would have been done on a more bipartisan basis and would have gotten broader buy-in, and we wouldn't be continuing to litigate it 5 years later. So some of this is an artifact of that. And certainly some of this is a concern that, we are approaching some of the same mistakes. So for instance, I'd be the first to say, I'm not sure that any level of transparency is going to get me to the point where I think that designating companies as systemically important is not going to send the wrong signal to the marketplace. But I would like to have transparency in how do you get that designation, because I never felt like in the passing of Dodd-Frank and since there's really been a debate about, well, what do you mean by systemically important? What are the mechanisms? Why is this company different than that company, rather than, to me, what seems to be kind of like a gut, well, you know it when you see it.
And there was really never a debate in terms of whether SIFI designation would be expanded to different industries. And I'm curious.
Yeah, Barney Frank, I think, has said that he never intended this to be insurance. So, again, I think that those things need to start. You certainly can get to the legislating down the line, but I'm not sure that I think that, the Collins Amendment and the change for the capital standards, I didn't even think that was needed, but, apparently the Fed did. So that said, I think a lot can be done to build a dialogue and build trust that you don't even need to legislate for, but I certainly don't think we're there now.
Yeah, the Shelby bill, the portion of the Policyholder Protection Act, walling off the insurance assets, very important. Opening up the FSOC process, essentially, that to give an exit ramp, to give the criteria, the factors, all of those as the lawsuit you referenced is seeking. Very important. So I do believe that the congressional oversight, and I've seen an increase in that over the past year or two, which is very, very important because, there's someone watching over the shoulder, internationally and domestically, making sure that the insurance industry, the regulators, and the cooperation that's needed between the federal agencies and the states, as best as possible anyway, has some congressional oversight.
I do want to pick up, though, on this issue of distrust of the Fed and the regulators. I don't think it was because of the nonpartisan, bipartisan, anti-partisan process. I think that there's been a lot of ideological buildup of distrust of the Fed. But leave aside where it comes from, I do think that Congress has to wrestle with the idea that everybody says transparency is the best disinfectant, transparency is this, transparency is that. Congress talks a lot about business. Think about your business. If you have somebody working for you and you basically don't trust them, And so they not only have to sit in an open carrel and not only know that you can look at their files when you need it, but they have to do everything in front of you. It means they take no risks. It means they're very scared about what they can say. It means they're not open to change because then it looks like they're flip-flopping, and it means it wastes a lot of your time. So I think Congress has to stop and think, if it's going to have the kinds of debates my colleagues on the panel mentioned, which I think are legitimate substantively, it has to stop assuming that they get an unalloyed good if they just distrust the Fed.
I want to come back to the suggestion that you add someone with insurance expertise to the Federal Reserve. And I don't think, from my perspective, I don't think that solves the problem. I think we have a pattern of let's add a token insurance person to a group of a bunch of bankers. And I think what we really need, if we are going to engage the federal government on insurance policy issues, we need a strong, independent insurance voice. And I come back to the fact that there is no one on Team USA who is a federal decision maker, who is a policy maker on insurance with the final say. We need someone in the federal government if we're going to continue to engage the federal government on insurance issues. And that's a discussion I think we have to have. We have to figure out, this thing is evolving. So you got Treasury over here doing things, and you got the Federal Reserve doing things, and what we have to figure out is what is the long-term plan here, because it's getting very messy. From my perspective, I think there is a way to create a good partnership between the federal and state government. It can't be done with the structure that's currently being built. And it has to involve a combination of the states being as good as they can be, and there's room for improvement there, an independent federal voice, and then something that recognizes the fact that the states work through the NAIC and gives the NAIC a seat at the table. There is a tendency in these federal agencies to want to pretend the NAIC doesn't exist. And you can't do that in the system we have. So that means doing something about the credibility of the NAIC.
I just want to say that for all my poo-pooing process, what I've kept saying is the NAIC has strengths and the weaknesses in the centralized representation, and I agree completely with Terry on that. And so I'm going to usurp the chair and just ask my fellow panelists a question, which is, would you support a system where, say, and this is just a question, making the chair of the NAIC or some sort of super chair of the NAIC who has standing more power than having alternative at the federal level?
So we actually, when I was at, and Christina was a part of this, so she remembers it, we started down the path of trying to figure out what might a federal-state partnership look like. And what you have to deal with are the issues of the deference to the states in our federal constitution. So the federal government can't really say the NAIC has these powers over other states. Federal government can have powers over the other states, but they can't give somebody else powers over other states, especially if it's a state, if it's a group of states. And so figuring that out is tricky. I think there's a way to do it, but it's got to be thought through carefully.
Great question. But bouncing off of that, I mean, FSOC really was kind of set up to in some ways act as a bridge to get all of the regulators together and to, hopefully get everyone a seat at the table. Obviously, there's criticisms of FSOC that it hasn't done that, and there are supporters of FSOC to say that it does do that. But in terms of the, too big to fail and SIFI designation, and I want to get back to this point, do you think, and you had mentioned that, it's just become a little bit too messy and there's no long-term plan. Are you looking for someone from a regulatory landscape to lay out, this is the long-term goal, this is where international SIFI designation is headed, this is where domestic SIFI designation is headed? Is there an understanding within the industry of what exactly the long-term goal is in order to stop too big to fail and that? Yeah.
I get done with these things and I say, you should have kept your mouth shut more. But yeah. I think there are two things. I think there's the question of long-term, what is this structure going to look like? Because no one is happy right now with how this structure is evolving. Nobody. Okay, long-term, what's the structure going to look like? That's a problem. Then there's the other thing about long-term, what are we doing about this kind of policy around systemic risk in insurance. That there are disagreements over whether the companies that have been designated are in fact even systemic, right? But beyond that, where are we trying to get? Are we trying to get to a world where, yeah, you have some companies designated systemic and they got some higher capital charges slapped on them and the Federal Reserve is all over them, but that's fine. We got these companies. From my perspective, that shouldn't be the long-term goal. The long-term goal should be to get those companies out of being systemic. And that's why I've never jumped in on the debate, let's lower the capital standards on these insurance companies, because as far as I'm concerned, give them an incentive to get out. Give them the instructions on how to get there and get them out of there. I don't want any insurance SIFIs. So I think there are two. There's the structural path, and then there's the...
Yeah, I totally agree with Terry's analysis there on this. If you get them out of there, tell them what the exit ramp is. Tell them what caused them to be designated. And our insurance experts on the FSOC were not listened to when it came to that designation process.
So let me reiterate that. So I mean, I think so far the process and transparency concerns have essentially been, somewhat an outgrowth of what are fundamentally policy differences underlying. So again, I don't think any company, bank, or insurance is so important that its creditors can't become equity holders, and that we somehow need a taxpayer bailout. I don't think anybody is in that camp personally, and that's a policy difference. And so I do think that because there wasn't buy-in across the board in the policy rationales behind what we're doing, and that's what I mean by bipartisan or something, because you would have had a different bill if it was bipartisan, and you might have gotten buy-in to a whole different policy set. So to me, the value of transparency in this instance is I think we need to have a more open and vigorous debate in this country about what systemically important, or as I think it's synonymous with too big to fail, means. And I don't feel like we've had that conversation in any substantial way. Now, of course, my sense is that if we have that conversation, then I will, of course, be proven right, and we can stop labeling these things. But, of course, I'm open to having my mind changed in that conversation, too. But I think that's a conversation that needs to happen. That isn't, and I'm the first to say, I think it derives from some fundamental policy differences.
I agree it's about fundamental policy differences, but I would emphasize that people on the left and the right, say Tom Hoenig and Senator Brown, can certainly agree on too big to fail. And I think we all are agreeing. I think the description Terry gave of what the outcome at the moment is we're apt. And it is whether you believe on which side of this you're on, I think we can all agree that the goal would be to not have systemically risky institutions. And part of that is to have the guts to break up institutions that are too big, but also to recognize that too big means something different in banking than in insurance, and it's not as obvious what too big means in insurance. Insurance, it may be more a question of regulating and limiting what products and what areas you're in, as opposed to banking, where the issue may be one of size. And these are the kinds of discussions. I'm not sure we haven't had that debate, but I'd like us to get to that point.
Yeah, insurance companies getting involved in non-traditional, non-insurance activities. There's the risk.
Yeah.
I was just going to say, the arguments that are made about insurance institutions being systemic are twofold. There's the AIG issue. We all agree. That's one you solve. That's where you sort of prevent companies from engaging in those kinds of activities. That's fine. Right. And being too interconnected with the banks and insuring all the assets that the banks hold and so forth. But then the other argument that has been very problematic from the insurance sector is the one that goes, there can be an insurance company can become troubled. There will be a policyholder run on this company. And if the insurance regulators use the tools they have always used successfully in the past, that will create panic and runs at other companies. And purely theoretical, but you say never happened in the past, and the response you get is, well, just because it never has doesn't mean it can't. And that's the one that I think we got to get that straightened around.
But I do think there is some room, not for over-regulation in that area, but I do think there is some room, particularly for educating the bank sector regulators and some of the people on the Hill, to make it more clear why that might not happen, what are the things in the system that prevent that from happening. That argument hasn't been made. Instead, we get the argument it never happened before now. And that may be true, but that's not the most persuasive argument. And you have other pieces of the financial system making that kind of argument, like the mutual fund industry, which is false. So again, I encourage my friends in the insurance industry to fight back on this, to change this, but don't just make the argument, oh, we've always done it right.
But I'm okay. I think they have tried to make that argument. Here are the tools that we have used in the past that have worked. We can use those again. And the response is, companies are getting more complex. It's not clear those tools will work anymore. But prove a negative. Prove that these tools.
I mean, let's be grown-ups here. You always have to prove a negative in any of these things. So the issue is, can you show through some reasonable form of simulation, or can you show by showing that the complexity of insurance companies isn't getting into these non-insurance products, or agreeing that those who stay out of those products are the ones who shouldn't be designated? These are the kinds of initiatives you have to think about.
My final question, very quickly, and thank you all for this great dialogue. And I'm going to ask this, the question I always end my interviews with is, why should people outside of this room care? Why should the debate that's being had here in Washington, why should folks care? I mean, clearly the issue of too big to fail is still very much on everyone's mind. But talk to the people who don't understand all this wonky stuff in this other language. Why should they care? Very quickly, why should they care?
So they should care because, of course, we had a very costly, painful financial crisis. And, my concern is, I think, just the opposite in terms of higher capital and things like that. I worry that if we go along the path of regulating insurance companies like banks, that they will actually become more leveraged and more risky, and that we will make crises more likely. So let me end with saying, I think there's a presumption in this debate that somehow what our bank regulators were doing worked in and of itself, and that they are somehow earned the trust. So I'll end with saying, to me, sometimes I think the logic of Dodd-Frank is if only we regulate everybody else as well as Citibank was regulated, everything will be okay.
Well, I think we should care, as the congressman said, because it affects affordability and availability of insurance products. And that hits people on Main Street. And these international standards flow down through NAIC model laws and recognition. In certain instances, we adopt the best that we feel fits to our system. But there are outside influences that regulators are working to apply that are appropriate and want to prevent those that are inappropriate. But I think availability and affordability of certain insurance products could be impacted severely.
I'm really concerned with the other side of the insurer's balance sheet, and that's what Main Street should be concerned about. Part of that is, as Mark Calabria just said, it's a matter of risk, that if you put the wrong kind of regulation on insurers, it can actually increase rather than decrease systemic risk. The other thing which we didn't mention at this panel, but which is critical, is we need more long-term investment. We need long-term investment in infrastructure. We need long-term investment in corporations and in people. Insurers play a huge role in taking their assets and investing long-term. If we force them into short-term government bonds or very liquid government bonds as a larger part of their portfolio, we get less long-term investment, which is worse for the country.
I'll just agree with everything that's been said. Well put.
Thank you all very much for coming, and thank you to our panelists for, I think Bob has a few, but thank you.
Brief remarks.
Thank you very much for coming, and thank you to everyone else.
Thank you. Thank you very much. Thank you all for coming. I want to thank the panelists as well as the members, and also definitely thank the Property Casualty Insurers Association of America for sponsoring this great discussion. Have a great day.